time to dive into the world of accounting.
Whoa. Yeah.
We've got a ton of notes and readings here,
Yeah, we do.
all ready to like help us unlock this world,
Mhm.
from basic equations to financial statements and all that good stuff.
Yeah.
But don't worry.
Right.
This isn't just some boring lecture.
Definitely not.
We're gonna make this fun, right?
Absolutely.
Especially for you first-year university students out there.
We're going to make it make sense for you.
Gonna make it make sense.
Yeah.
So I'm seeing this accounting equation thing everywhere. Is that like super important?
Oh, it's the foundation. It's the bedrock of accounting.
Oh, wow.
You can think of it, as the basis for everything.
Okay.
It's actually pretty simple, though. It's assets equals liabilities plus equity.
Okay. I think I've heard that.
It's a balancing act.
Okay.
Every financial move a company makes has to keep that equation balanced.
So like if a company like buys something new, does that mess with the equation?
It does. Let's say, for example, a bakery buys a new oven.
Cool.
That oven, it's an asset. It's something they own, right? So if they pay cash, their cash goes down, but the equipment, the oven goes up by the same amount.
Gotcha.
Keeps it balanced.
So they always got to stay balanced.
Exactly.
Okay. So what if they take out a loan to buy the oven?
Oh, okay. So now it gets interesting because now the oven is still an asset,
Right.
but they also have a liability because they owe money to the bank.
Okay.
So that loan amount gets added to the liabilities,
Right.
which keeps the equation balanced.
Gotcha. So it's like kind of like a dance.
It is.
They got to move together.
Yeah, everything moving in sync.
I see. Okay. I'm also seeing this financial statements thing.
Right.
Is that related to the equation at all?
They are. You can think of financial statements as like storytellers.
Oh, okay.
They
Yeah.
translate all those transactions and numbers into a narrative that helps us understand a company
Okay.
and their financial health.
So if the equation is like the setup,
Yes.
the financial statements are like the actual story.
That's a great way to put it.
Oh, cool.
And there are a few key players.
Okay.
You have the balance sheet,
Okay.
the income statement, and the cash flow statement.
Oh, wait. I thought there were 4. My notes mentioned the statement of changes in equity too.
You're right.
Okay.
That one's like a close-up
Okay.
on the equity part of the equation.
Gotcha.
But let's stick with the main 3 for now.
All right. Sounds good.
So the balance sheet.
Yeah.
Imagine it as a snapshot,
Okay.
a freeze frame
Okay.
of a company's financial position
Gotcha.
at a specific moment.
At a specific moment.
Yeah, like a financial selfie.
Oh, a financial selfie. I like that.
Yeah. Okay.
So it shows what they own,
Okay.
what they owe,
Okay.
and the owner's stake at that moment.
Perfect. And the income statement. The income statement, it's like a report card
Right.
revealing how profitable the company was.
Hmm.
It tracks revenue and expenses.
So it's showing like, did they actually make money?
Yeah.
Okay, that makes sense.
It's all about understanding how effective a company is at turning effort into profit.
I see.
And then you have the cash flow statement.
Right, the cash flow statement.
Think of that one as the detective.
Ooh, okay,
It follows the money trail,
gotcha.
showing how cash moved in and out.
Right.
And this is important
Okay.
because a company can be profitable,
Okay.
but still struggle if it doesn't manage its cash flow effectively.
So they can make money but still have cash flow problems.
It's possible, yeah.
Yeah.
Imagine
Right.
a company sells a lot of products on credit.
Oh yeah.
Their income statement may look great, but if customers are slow to pay,
Oh, okay.
they might not have enough cash on hand.
To pay their bills.
Exactly.
Ooh, okay.
So that's where the cash flow statement comes in. It helps highlight those potential cash crunches.
Okay, I see.
So each statement provides unique insights.
I'm starting to see how they all kind of work together,
They do.
like different pieces of the puzzle.
Yeah, and they help us get a comprehensive understanding.
Okay. I'm a little confused though about how companies keep track of all these transactions.
Right.
I see double entry bookkeeping in my notes. What is that?
That is the heart of accounting.
Oh, wow.
It ensures accuracy.
Okay.
Think of it like checks and balances. Every transaction, big or small, is recorded twice.
Twice. Why twice?
It impacts at least 2 accounts,
Okay.
and it helps catch errors,
Oh, smart.
and it keeps the accounting equation balanced.
Gotcha. So like every little thing they buy or sell.
Everything, yeah. So if you buy a cup of coffee
Uh-huh.
using your debit card, that's double entry.
Oh, wow.
Your bank account decreases.
Okay.
and your expense for the coffee increases.
Yeah.
Simple as that.
Okay. So how do we know which way the numbers are supposed to move? My notes mention debits and credits, but they kind of confuse me.
I hear you.
Yeah,
Debits and credits can be a little intimidating,
for sure.
but it's really just a system for tracking increases and decreases.
Okay.
So think of it this way. Debits increase asset accounts or decrease liability and equity accounts. And credits do the opposite.
Okay, opposite.
So they decrease asset accounts or increase liability and equity accounts.
So they kind of work together.
They do. They always have to have a corresponding
Okay.
a corresponding debit or credit.
To keep things balanced.
Exactly.
Gotcha. Can you give me like an example of a real business transaction?
Sure. Let's go back to the bakery.
Okay, the bakery.
Let's say they buy flour on credit.
Okay.
So that increases their inventory
Okay.
by, let's say, $500.
Right.
So we would debit the inventory account.
Okay.
But they also increase their liability because they owe the supplier money. So we would credit the account's payable account.
Oh, okay. So one transaction, two entries.
Exactly. Keeps it balanced.
Right. I think I'm starting to get it. It's all starting to click.
Good.
Getting
You're
that.
you're seeing the logic, and this system feeds into those financial statements we were talking about.
It's all connected.
It is.
This is so cool.
Yeah.
All right. So my brain is definitely getting a workout.
Yeah.
But in a good way.
Yeah.
Like we've covered so much already.
We have.
But there's got to be more, right? What else is to accounting?
Well, now we can start using some really cool tools to analyze.
Tools, ooh, like gadgets and stuff.
You can think of it that way.
Okay.
They're called ratios.
Ratios.
Yeah. Ratio analysis. It helps us really see what's going on beneath the surface.
It's kind of like X-ray vision.
Kinda, yeah.
Ooh, I like that.
So essentially, we use ratios to compare different numbers on the financial statements.
Okay.
And it reveals relationships between them.
So it's not just about the numbers themselves.
No,
Okay.
no. It's how they relate to each other.
Gotcha.
And these ratios can tell us a lot about profitability, efficiency, even risk level.
Okay, so what kind of ratios are out there?
Well, a lot of them. Some of the most common ones fall into categories like liquidity,
Okay.
profitability, solvency. You can think of them like vital signs for a company.
Well, that's a good analogy.
Yeah, helping us assess its overall health.
All right, cool. So let's start with liquidity. What is liquidity?
So liquidity is a company's ability to pay its short-term bills.
Like to keep the lights on and stuff?
Yeah, exactly. You
Mhm.
know, making sure employees get paid.
Okay, so like if I'm low on cash and my rent is due,
Mm-hmm.
that's a liquidity problem.
That's a personal liquidity problem, yes.
Gotcha.
And there are certain ratios that help us assess a company's liquidity.
Okay.
One of the most important ones is the current ratio.
Outcome ratio.
And that measures the company's ability to pay off its short-term liabilities
Oh.
with its short-term assets.
So if they have a lot of cash and stuff they can sell quickly, that would be good.
Exactly.
Okay.
A high current ratio suggests that a company is in good shape
Right.
to meet its short-term obligations.
Okay.
And a low one could be a sign of trouble.
Oh.
Maybe they're having trouble collecting payments,
Okay.
or their inventory isn't selling.
Right. So what are some other liquidity ratios?
There's the quick ratio, sometimes called the acid test ratio.
Okay.
It's similar to the current ratio,
Yeah.
but it excludes inventory from the calculation.
Why would we exclude inventory? I thought that was an asset.
Well, inventory can take time to sell,
Oh, okay.
and some types might not be easily converted to cash.
Okay.
So the quick ratio is a more conservative view.
Right.
It focuses on assets that can quickly be turned into cash.
So it's like if things suddenly get bad.
Yeah, it's a stress test.
Okay.
It makes sense. So then you have profitability ratios.
Okay. Profitability. So this is like how much money they're actually making.
Exactly. It helps us answer questions like, are they using their resources well?
Okay.
Are they pricing effectively? Are they keeping costs under control?
So like with my lemonade
Yeah.
stand,
Mhm.
I got to make sure I'm making more money than I'm spending on lemons.
Right. And one of the key ratios here
Okay.
is the gross profit margin.
Okay. Gross profit margin. What is that?
So that tells us how much profit a company earns on each dollar of sales after deducting the direct costs of producing those goods.
So like if I sell a cake for $50
Yeah,
and the ingredients cost me $20,
Huh.
my gross profit margin is 60%.
you got it.
All right. A higher gross profit margin means a company is doing a good job
Okay.
at managing those costs.
Gotcha, gotcha. Are there any other profitability ratios? There's the net profit margin,
Net profit margin.
which is similar to the gross profit margin.
Okay.
But it takes all expenses into account,
Oh.
not just the direct costs of production.
So it's like the final number,
Yeah.
like what they really made after everything.
Exactly.
Okay, cool. And then what about solvency?
Solvency. So solvency is all about a company's long-term
Okay.
financial stability,
Okay.
their ability to meet those long-term obligations.
So like if I take out a huge loan for something
Uh-huh.
and then I can't make the payments,
Yeah.
that's a solvency problem.
Exactly. Exactly. And one of the key ratios here
Okay.
is the debt to equity ratio.
Debt to equity.
Yeah. It compares a company's total debt to its shareholder equity.
Okay.
So it basically tells us how much of the company's financing is coming from debt versus equity.
So if that number is high, that's bad.
It can be, yeah. It could be a sign that they're taking on too much risk,
Oh.
or that they might struggle if things take a downturn.
Okay.
So then you have the interest coverage ratio,
Right.
which measures a company's ability to make interest payments on its debt.
So a higher number here is good, I assume.
It is. It
Yeah.
is. It's like having a cushion to absorb those expenses
Okay.
without putting a strain on their overall financial health.
Gotcha. Man, these ratios are really powerful.
They are.
They really are like X-ray vision.
They can be. Yeah.
Okay. So my notes also mentioned liabilities and equity.
Right.
Didn't we cover that with the accounting equation already?
We did.
Okay.
Well, we can go a bit deeper.
Okay, ready.
So liabilities,
Yeah.
essentially what your business owes to others.
Right, the debt.
The debt, exactly. And we can break down liabilities into a few different categories
Yeah.
based on when they're due.
So like some got to be paid sooner than others.
Yeah, you have your current liabilities, which are due within a year, and
Right.
then long-term liabilities, which
Alright.
are due after a year.
So current is like my phone bill and long term is like my student loans.
Yeah, there you go.
I get it.
Good analogy.
Okay, so what are some examples of current liabilities?
You have accounts payable,
Okay.
which is money owed to suppliers
Right.
for goods and services they've provided.
Okay.
Salaries payable,
Right.
money owed to employees,
Right.
and short-term loans, which are,
Loans that need to be paid back soon.
within a year, yeah.
This too.
So these are all obligations that keep the business running day to day.
Okay, makes sense.
And then long-term liabilities. These are typically larger debts that a company takes on to finance bigger investments. Things like buying property or expanding. Some examples are mortgages, bonds payable,
Right.
and long-term loans.
So this is more like strategic debt.
It is. It
to
is.
help them grow.
Yeah. Yeah.
Okay, so that's liabilities. What about equity?
Okay, so equity, that represents the owner's stake in the business.
Okay.
It's the value that belongs to the people who have invested in the company.
Okay, so what are the parts of equity?
Well, you have share capital,
Okay.
which is the money a company raises by issuing shares of stock.
Yep.
So if a company wants to go public,
Right.
they issue shares, and that the money they raise from that is share capital.
So that's like the initial investment.
It is. It is.
I gotcha.
And then
And you have retained earnings.
retained earnings. What's that?
So retained earnings are the accumulated profits
Okay.
that a company has earned over time, but hasn't distributed to shareholders.
Oh.
It's the profit that they've chosen to reinvest back into the business.
So it's like their savings account
Kind of, yeah.
to help them grow in the future.
Yeah, it's a good indicator of a company's growth potential.
Okay, so initial investment and then their savings.
Yes.
What else? You also have additional paid-in capital.
Okay.
This one's a bit more technical,
Right.
but it's essentially the amount of money investors paid for shares
Yeah.
above what's called the par value.
Par value, what's that?
Par value is a nominal value assigned to a share of stock.
Okay.
It's often a very small amount, like $1 or even a penny.
Hmm.
It doesn't reflect the market value, but it's more of an accounting mechanism.
Gotcha.
So if a company issues shares with a par value of $1,
Yeah.
but investors are willing to pay $10,
Okay.
that extra $9 goes into additional paid-in capital.
Oh, okay.
So it's the premium that investors are willing to pay.
Interesting.
Yeah.
Okay. Wow. This is a lot, but I'm starting to see how these things are more than just numbers.
Yeah.
Like they tell a story.
They do. They do.
Okay. So, accounting, it's always changing, right?
It is. It is.
So what are some of the big trends we should be aware of?
Well, one major trend is sustainability.
Right. And corporate social responsibility.
Okay, that's really important.
It is. It is.
Yeah.
Investors and consumers are demanding more transparency from companies.
Right.
About their impact. And accounting is playing a big role in measuring and reporting that.
That's great.
Yeah, so traditionally accounting has just been about, financial performance.
Right.
The bottom line.
The bottom line.
But now there's a growing demand to account for their environmental and social impact as well.
Okay.
So that's led to things like environmental accounting and sustainability reporting.
Can you explain those a little bit?
Sure. So environmental accounting focuses on tracking the costs and benefits of a company's environmental activities.
Okay.
So it's measuring things like pollution, waste management, resource consumption.
So it's putting a price on their impact.
Yes, that's a good way to put it.
Okay.
And sustainability reporting goes a step further.
It's about disclosing a company's overall environmental, social, and governance performance to stakeholders.
Okay.
So this includes things like carbon emissions, employee diversity, ethical business practices.
So it's more holistic.
It is.
Than just, how much money did you make?
Exactly.
Okay. So what about technology?
Oh, technology. Technology is changing everything.
Yeah.
You have automation, artificial intelligence, cloud computing, blockchain.
So many things.
Yeah, it's transforming how accountants work and how businesses manage their finances.
Okay, let's break it down. Okay. Starting with automation.
Okay, so automation is streamlining all those repetitive tasks. Okay. So accountants can focus on more strategic work. Right. Things like data entry, invoice processing.
That stuff's got to be boring.
It can be. So those things can be automated, allowing accountants to spend their time on more complex analysis and decision support.
Gotcha.
And then artificial intelligence.
Okay.
That's taking automation to the next level.
Okay.
AI tools can analyze huge amounts of data, identify patterns, even make predictions.
Wow.
It's changing things like auditing, fraud detection, risk management.
So it can help catch people who are doing bad stuff.
It can, yeah.
That's really cool.
It's a powerful tool.
Okay. What about cloud computing?
Cloud computing, so that's changing how businesses access their financial data.
Okay.
Cloud-based software allows businesses to store their data securely online.
Oh, okay.
So it's accessible from anywhere.
So I don't have to be in the office to do it.
Exactly. Okay. You can be anywhere with an internet connection.
Makes it much more flexible.
It does.
Okay. And it makes collaboration easier, right?
Absolutely.
Like if I'm working with someone?
Yeah. Teams can work together.
We can both see the same thing.
Exactly.
That's awesome. And then the last one, blockchain.
Blockchain. Yeah, that's it's all about creating secure, transparent, and tamper-proof records.
Okay.
It can really transform accounting by enhancing trust and efficiency.
Okay.
So imagine, a world where every transaction is recorded on a blockchain.
Oh.
It's an immutable audit trail.
So you can't fake it.
No.
It's all right there.
It's all right there.
Okay.
And then you have smart contracts.
Smart contracts.
Which are self-executing contracts that automatically enforce terms.
Oh, wow.
So this could change things like accounts payable, supply chain management, even royalty payments.
Man, blockchain is pretty powerful.
It is. It has a lot of potential.
Yeah. Okay, this is really cool. I'm feeling much more excited about accounting now than I was, a couple hours ago.
That's great.
But for now, I think my brain needs a little break.
Yeah, me too.
From all these numbers.
It's been a lot.
We'll be back soon though.
We will.
To put all this knowledge to work.
Yes.
Right? And really dive deep into financial statement analysis.
That's right.
Sounds good.
All right.
Okay, welcome back.
Back for more.
For the final part of our accounting deep dive.
It's the final act.
All right, so it's like we've learned the language, explored the world. Now it's time to put it all to the test.
Exactly.
I'm ready to be an accounting detective.
You and me both.
All right, so where do we start? What tools do we use?
Well, we talked about ratio analysis.
Oh, right, right.
But there's other techniques.
Okay.
Like horizontal analysis.
Okay.
Vertical analysis,
right,
and benchmarking against industry averages.
Okay, so lots of different tools to use.
Yeah, think of them as our magnifying glass fingerprint kit.
Oh, I like that. Okay, so horizontal analysis, what is that?
So horizontal analysis is all about spotting trends over time.
Okay.
So imagine you're looking at a company's sales figures.
Okay.
Over the past 5 years.
Yeah.
Are they going up, down, staying the same?
So we're looking for changes.
Exactly.
Okay.
It helps us understand the trajectory of a company's performance.
So it's like charting their journey on a graph.
Yeah, you got it.
Okay.
Looking for those peaks and valleys.
Right. So we can see like, oh, why did sales drop that year?
Exactly.
Okay, that makes sense.
So vertical analysis.
Okay, vertical analysis.
It's a little different. It's all about proportions.
Proportions.
Yeah. So instead of comparing numbers across different periods,
right,
we're looking at the relationship
okay,
between different items within a single financial statement.
Okay, can you give me like an example?
Sure. Let's say we're looking at an income statement.
Okay.
We might express each expense item as a percentage of total revenue.
Oh.
So it helps us understand how much of each revenue dollar is going to different expenses.
Okay.
So if marketing expenses are increasing,
that could be bad.
It could be a sign that they're having to spend more to maintain sales.
Right.
Which could impact profitability.
I see. And then you mentioned industry benchmarks.
Yeah.
What are those all about?
So comparing a company's financials to industry averages, it's crucial for gaining context.
Okay.
So think of it this way. A basketball player scores 15 points a game.
Okay.
Sounds impressive, right?
Yeah.
But what if everyone else in the league is averaging 20 points?
Oh, then it's not so good.
Exactly.
Yeah.
So industry benchmarks, they provide that yardstick for measuring performance.
Okay. So it's all about seeing how they stack up against the competition.
Yeah.
Okay.
Identifying strengths and weaknesses.
Right. So we've got horizontal analysis, vertical analysis, industry benchmarks. Mm-hmm. What about ratio analysis? We talked about that before.
We did. And that's still super important.
Right.
All those ratios.
Right. The liquidity and all that.
Yeah. They provide clues about a company's health.
Okay.
But we got to use them wisely.
Not just like blindly trust the numbers.
Exactly. We got to understand the story behind them.
Right. Okay, so it's all about connecting the dots.
It is.
Using all these different tools.
Yeah.
To get a complete picture.
Exactly. Financial statement analysis.
Right.
It's about seeing the big picture, not just focusing on isolated numbers.
Wow, this has been an amazing deep dive.
It has.
I feel like we started knowing nothing.
Yeah.
And now we're like accounting detectives.
You got it.
It's been a wild ride, but I'm feeling much more confident now.
That's great.
Yeah.
And remember, the journey doesn't end here.
Right.
Counting is always changing.
Keep learning.
Keep exploring.
All right. Well, thanks for joining us on this accounting adventure.
It's been a pleasure.
We hope you learned some valuable skills, maybe even discovered a passion for the power of numbers.
Yeah.
Until next time, happy accounting.
Happy accounting.